Alright, so beyond this point, now we have to do is basically look at some examples. Now I've put here numerous examples with notes so you can see under live market conditions what to really look out for. Your job is now to go over these examples. When the market is sideways, when it's trending, where there's change of character, where there's change of structure, a break of structure, a change of character. I've explained these with numerous examples, but what you must really do now is to go on to a live chart and go through many charts to make sure that you can spot these. Okay, and the reason for this is once you start to spot these with ease, as your eyes get used to it, then you'll begin to match these to timings, just like we did with this NASDAQ example yesterday, as you can see. And the market actually went to that pivot level, which was here. I showed you about the pivots and gaps as well. And the more you look, the more you find on a daily, the more you find on an hourly, doesn't matter what time frame. The important thing is to keep looking and then become accustomed to these setups, because once you become accustomed to these setups, then it's going to be like magic. You're going to think like, oh my god, impulse wave, retracement. Also, if you've taken other if you've taken the coaching program, if you had taken the coaching program, you'd also know how to look at formations, how to look at waves within a cycle to kind of like measure things out. But let's keep it nice and simple. The important thing is the technical analysis shouldn't be too difficult. When I look at the chart, I should be able to see a direction. I should be able to see what's going on so I can get my head in there somewhere and match it to my trading hour. So like I said, I've got a bunch of examples here with notes. I really recommend that you go through them and you look for many examples so that your eyes can really get used to reading the charts. Okay, now here I've got waves and demand and supply, and this is pretty much a bit of what we did, how demand and supply works with waves in terms of retracements, filling in gaps and coming back. But really this is a whole topic on its own. But if you've done waves analysis, you can actually combine it with demand and supply as well. Now let's take a look at some of the rules that we must keep for success. Now with every trading technique, there are some rules you have to keep. There's no other way, and this is no different. So with demand and supply, the first thing is, on the bigger time frame, identify the major support resistance levels, the zones. Where is the demand and supply levels? This is the first thing you must identify. And what is the direction? Don't go against the big time frame. Now I do say that, but because we're using trading hours, you can go against the big time frame, just like I showed with the NASDAQ example of yesterday, because NASDAQ yesterday had a swing day. So Monday was a swing day, and this is the daily chart. Okay, so this was a swing day. If this is a swing day, if this is going to be a swing day, I can look at a time and a price where I can buy. All right, so this is doable. Now the main trend, as you can see here, is down. Okay, but because we're using swing days and swing hours, we can be a bit more flexible with that rule. So just understand that if you had no timing, okay, going against the bigger time frame direction would be risky. So just be mindful that sometimes, I do break that rule simply because I know swing days and swing hours, and that's why, because the risk is reduced tremendously then. Look for fresh supply and demand zones in the lower time frame to enter in the direction of the bigger time frame. Once again, this is only valid if you're not using timing. If you're using swing days and hours, you can be flexible. These occur a few times during the day if you're a day trader or during the week for short-term swings. Now this can happen if you're using a smaller time frame. For example, let's say we're using here the 4-hour time frame. Okay, so in fact we can go down to the 1 hour, because if we're day trading you can go down into the 1 hour. So for example, this is the impulse and the market came back here, okay, before going up. Now if you add to this Fibonacci, you can see the market came into the Fibonacci and went up, and you can see there are no gaps here. See how the wicks are all touching? There's no gap. See how it's been filled and all is going honky-dory. So this has got room to go up. So what I can do is come into the smaller time frame, and in that smaller time frame look for a place to get in. Okay, and this can happen during the day. Sometimes it may not. If you go down into the 1 minute and the 5 minute, obviously you will get more. Okay, I don't do that. That's really dependent on your style of trading, but I don't recommend scalping, so I don't. We're already getting good entries. So all you have to do is wait for the place where the market took off. Wait for the place where the market broke out. So for example, if the market breaks out and closes on top of that, your place to buy is going to be here, isn't it? Okay, this is going to be your zone. You're going to match it to a trading hour and you're going to push it up in that direction. And when that goes up, and then you can also, depending on where it gets to, you can also put a Fibonacci here to measure that retracement. So depending on your time frame, you can get, you know, a few trades in a day, or sometimes you may not get any at all. And in fact, if you're doing trading on the daily, let's say you're doing the bigger time frame, as you can see, it can take some time for the market to come up before it goes again. Okay, so same here. For example, we might have a few days going up before selling again. All right, so this is why not going against the bigger time frame is important, so you can keep your flow. Also, one other thing is, whenever you're trading, you just have to make sure you have a target, like you know where you're going. Okay, so this is a big long wick, so I'd like to take this wick as an opportunity, and this is a level which we can get to. Also, this is a demand supply operation, but you can use also support resistance levels. So if the market does come back into here, okay, and also this is the zone where they took off, you see how heavily they bought here. So if I'm going to sell again on a high, I will want to target this zone, and if it breaks through, I can manage the trade and push it down even further. So whatever you're doing, buying or selling, you must have a target zone where you expect the market to reach, because if that fails, then your trade plan is going to fail, and you need to have an exit strategy. You need to have a management strategy. This is why these are important. So wherever you're going, same here. For example, it was a swing day. Now, because we know swing days, obviously for us it's a different ball game. Whoops. Let's do this. Let's make this green. Okay, here we are. So obviously this is what we're going to be looking at here. Okay, so this is it. So now this line for us is going to be a target if we are long, and you can see the gap here as well, and so that gap is also going to be this zone here. So now you can see that that little triangle we just formed here becomes a target zone for us to sell back down again, or this is going to be the zone, right? So we've got two levels where we can enter the sell trade again if the market comes back up. Okay, so understanding the bigger time frame is really important, and going with that flow is really, really important. When market is at at these levels, wait for change of character and break of structure implying the reversal. Okay, so let's take a look at that. Now, in order to do that, what we need to do is go to a smaller time frame. Okay, so let's first of all find a trade with that kind of an action. Let's see, this is a 15-minute chart, so this is from yesterday, right? So look what's going on here. Now, let's say I've decided I want to go up, right? The first thing that I need to look for is a change in character. Now, remember what the change of character was. It was the first resistance that broke out. Now, this is the first resistance on the smaller time frame, and see how bullish that is. Okay, this is where the break of structure happens, because this is where the triple top, well, it's not a triple top here, but a resistance level here, broke out right there. Okay, and once it broke out, as you can see, it just rushed up. Now here, these candles kind of closed each other up with a gap, and you can see the market did not come back at all, so there was nothing to do here. Okay, so let's take a look at something else. Let's take a look at US 30. Now, this is interesting on the US 30. Okay, the market has been coming down. Let's turn this into a 4-hour chart. Let's tighten it up. Here we are. Okay, now this is interesting. Why? Because first of all, we've got a market trend coming down. Okay, so this is our trend line, and it has been broken. So the first place where the market broke out is that resistance there. Okay, and closed above it. So there's change of character. Then we have here, as the market broke out here, we have a break of structure, and then the market comes back. Now look where the market is coming back to. Same place it broke out of. Okay, and then going up. Now, how do I handle that? Well, this is already done, and now you can see we've got a big move up. Now the market came back down, so what can we do? Well, we can do this. As you can see here, we're at the 25 zone. This is really nice. The market bought aggressively, it went up, it broke structure. Now we're back, and the market bought again. So this zone now for us becomes a place of interest. Now let me get rid of these, and in the 4-hour chart, let me include this big wick, and let me turn this into a 15-minute chart. And this is going to be the zone. So when the market comes back, now I can adjust this to the last red candle before the breakout happened. So this is going to be our kill zone. So if the market does come back down again, we'd like to buy to push up. Okay, now this is on the assumption that the market has turned around. Why? Because as you can see, we've gone up, came back into a Fibonacci retracement. Basically, that's a Gann retracement, 25%, and the market moved up nicely. If we come back again, want to go up again. And we can see here as well, on this 4-hour chart, there are some gaps to fill in the market. So the market can also come back into here again before we decide to sell, either at closing the gap or at the manipulation bar, this last blue bar here. But remember, I take the wick off the red candle because it did a higher high than that blue one. Okay, so then we've got zones coming into here as well. Okay, now if I enter that trade, okay, the first target is going to be this zone here because this is the high that it did. Okay, the second target will be up here. When you're targeting, don't target the tip, target the closing price. okay, because this is more likely to get hit than the wick. Okay, and then you can push it up into there, and it'll be, the rest will be a part of your trade management. Okay, so this, let's say I'm assuming that the market's going to go up. That's my assumption. We'll go up with it. We're going according to the bigger time frame by coming into the smaller time frame. Now, if our price doesn't come back there, okay, obviously there's nothing to trade. Okay, but that's how you would be trading it off. You'd be looking to target where they sold. Now, if you were bearish, if the bigger time frame is bearish, which at this moment it is, why? Because this level broke out and the market closed below. So any pullback is an opportunity for the market to sell off. This is a nice impulse wave. You see that big fall going all the way in there. So this impulse wave is a good retracement for us. Now the market's done the 37.5, and you can see that's a beautiful sell-off there. Okay, so what can happen here? If the market goes back up again, we'd like to sell. So let's take a look at the manipulation bar that caused this breakout. Now this is the bar here, the blue candle. Okay, and you can see the market really came up and sold at that bar, but failed to break this low. Okay, if it comes back up again, what it might do is it might sweep the stop loss here, because everybody's stop loss is going to be above here. So we might see the market going up here and then coming back down and then selling off again. So what we'd like to do, the market is going down, it's done a retracement. If we go back up again, this is a zone we'd like to sell at. So now you can go to the 4-hour chart. As you can see, we're not making things any difficult for ourselves. We're looking at the place where the market broke down, and we're looking at places where the market can push up, filling gaps, and then sell off as well. So this is a zone we'll need to keep in mind. The market will want to sell here, or will go slightly up here, or sell here, or sweep the stops and then sell. Now with so many options, because there could be several options here, right? Which one is the right place to sell at? Well, that's where your swing day and your swing hours come into play. If I have the zone I'm going to trade at, then obviously I want to do it at a swing day and at a swing hour, and that's it. And once the market comes up here again, I need to go back into the smaller time frame. Let's squeeze this up a little bit and watch how the market sold off here. Let's do this. This is going to be a bit tight, but what can you do? Let's do this a little tighter. Okay, so this was the zone, right? Market coming up and then selling in this zone. Now if I open this up a little bit more and a little bit more and go back, okay, I should be able to spot, that's your blue bar there. Okay, and then I should be able to, on a 15-minute chart, say this is the bar, because that's the last manipulation, and you can see the market falling off. Now look at the gap there. Okay, the market kind of filled it with this little bar here. If we go back into that future, see where that happened? In that 15-minute bar that I just drew, because you go into the smaller time frame, you're gonna, what are you gonna do? You're gonna narrow it down, okay? And then the market sells off. Now watch this. Once the market sells off, what is it doing? It's doing the same thing. It's breaking the last swing, closing under it, and then retracing. Let's do this. And then retracing back to sell off again. Okay, and that's the only thing that's happening. Now here you have to, once it starts to go up, you can only put your Fibonacci once the market starts to go up. So once it starts to go up, you have to make sure that you're at some level, and it has to match a time if you want to sell it. So the market came down, it's gone up. If it's a time, you can sell it. That is the 27th of March 2025. Let's check it out. Okay, so this is 24th to the 28th of March. So 27 is going to be a Thursday. So on Thursday, this is London, my time. Remember, the hours are UTC plus 3. You got to adjust to my time zone. 1:30 on a Thursday, and then we've got 4:15, 4:35, 5:25, 5:55, and these are New York mornings, right? So I've got New York morning here. I've got London session here. So let's take a look. 1:30, 4:15, and 5:25. Let's see. 1:30, 1:30, 1:30. This is 1:30 here. 4:25. Whoops. That's your 4:25. This is your 4:35. So the market makes a low at 4:35, takes me up to 5:25. Let's see where 5:25 is. This is your why am I making this so hard on myself? Let's just make it bigger. Okay, so this is 5:25 is on this bar, and then I've got 5:55, which should be on that bar. And where are we? We're exactly where the market's been selling off. Look, Fibonacci levels, and the market just selling off. So this is what I mean about using time and price together when you're doing your technical analysis. So whatever really technical analysis works for you, you can do it. This is why, you know, any method will work with timing. You just need to be on top of your game. So going back into the smaller time frame and matching it to your hours is what I wanted to kind of explain here, right? So we're going with the bigger direction, but if you know the swing day and the swing hour, you can look for that change of character, the break of structure in a smaller time frame, and trade with your trading hours to kind of establish it and do it. Okay, so this is it, right? Let's take a look at the third one. Now, when market is at these levels, wait for a change of character and break of structure implying a reversal. So this is what you do on the smaller time frame. Remember, I went from the daily to the 1 hour and into the 15-minute. Now when the market gets there, you can do the same. You can go to the 5-minute and the 1 minute to watch for a change of character, a break of structure in the smaller time frame, and enter exactly the same way. Let's demonstrate that again, so I won't be lazy, so we get this all right. So this is where the market fell off, remember? So this was the zone. Now once the market does this in the 15-minute chart, okay, once you see a market breaking structure, then all you have to do is then go to the 5-minute chart. Okay, then in your 5-minute chart you should have a pullback to sell off. Here that didn't happen. Okay, so this was the zone. The market sold off and it never came back until there. Okay, so there was nothing really you can do. That went all the way into the 27th. See, that went into Friday. So what you needed to do then was on the smaller time frame, just wait for the pullback and match it to your hours. There was nothing else to do. Sometimes what will happen is this. Once the market falls, okay, let me get rid of that. Let's say we're going to use this level. This is ours. This was our original zone, right? So the market came. Let's take a look. This is the support they broke, right? Where did they break it? Look, that's the manipulation bar here. Let's make this a little bigger. Okay, see the blue manipulation bar? That's causing the break. So now that blue bar is going to be your zone. Okay, and that's the same thing. You're going to do the same thing. Now the market is on a 5-minute chart and you're entering. But remember, you're going to enter at a trade hour. Now this was not a trade hour. We'd never 9:30 for a trade hour. But we did have 1:30, didn't we? So if I extend this, okay, now look what happened at 1:30. Let's get into 1:30. This is 1:30. 1:30 is right there. Now look, the market goes down. Check out the 5-minute chart now. I'm doing the same thing. I'm not doing anything different. This is the support zone. Look, the last swing, making a higher high, closing high, and then breaking. Okay, now what caused the break here? What caused the break here is, let's do it, is this blue bar here. Okay, there. All right, and the market is above it. Okay, fair enough, but the time is right there, 1:30. Now sometimes what people will do is they'll take that as well, but we're working on a 5-minute chart. So on a 5-minute chart you have to check, whoops, not this one, you have to check if you have a gap or not, and there's a bit of a gap right there. Let's make this a little bigger so you can see. Okay, that's the 1:30, so that's the manipulation. Now look at the gap here between that candle, between this candle and this candle here. So this is your gap. So the market comes in to finish off that gap and it comes back in there. So that manipulation bar now is the blue one here. Okay, this is why if you make a mistake, it's okay because of your trading hours. Okay, because that's the breakout here of the swing. The market actually took it all the way into there, which is logical too, because that's one push impulse before the market comes back again. So if you take this as an impulse, the market's come all the way back into the manipulation bar. So even if you make a mistake, if your timing is good, say okay, the market went up, sold off, this is a trading hour, sell it off, and then you sell it off. Okay, because your bias towards the bigger time frame is down, so you want to sell. If you sold here, your stop loss would have been just above the high here, because if we are correct, it should go down, and if we are wrong, okay, we don't want to be in that trade. And then the rest of the hours, as you know, we're 4:15. Where is 4:15? Whoops. You can see how accurate these are. Now we're on a 15-minute chart. Look, this is 4:15. See how the breaking is happening exactly at that bar. The market's just breaking down, going all the way into 4:35. Let's see that 4:35. That's your 4:35 there, just crashing down. And then we've got 5:25. Let's take a look at 5:25. 5:25 is that bar there. Market's back up, and I've got 5:55. Okay, so 5:55 is there. Whoops. Is there. So within this time zone you see the market selling again, and it is not going higher. Look, this is 5:55. Once this is done, you see how the market is not going above the high it did in that time frame. It's just not, and then big sell off. Now look at the gaps here. Gap, 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 filled it all in, just a little bit left here, fills that all in and sells off again. Alright, so this is how you can use the bigger time frame and just bring it into the smaller time frame. When you match it to your hours, it should work nicely with a tight stop loss. And if it doesn't work, then your stop loss is really tight, and you don't want to be in a trade where you're wrong. Okay, so this is why you can keep a tight stop loss, and there's no hoping and wishing and so on. Okay. After the impulse wave, wait for the retracement to your demand or supply zone and enter the trade, which is exactly what I showed here. The market made that made that impulse move down. It retraced all the way back up into the demand supply zone, and then you enter the trade. The time is right. Remember here, the direction is to the is predetermined. You understand you're selling. Okay, you understand you're buying, you understand you're selling, and you're doing it accordingly with that. Because sometimes I see people, what happens is they want to sell, and all of a sudden they go, oh, why don't I go long here, because it's all of a sudden gone long. But okay, but what's the bias to the big side? Okay, if you're going to play both sides, get in and get out, get in and get out, you got to plan it ahead of time. And you know, if you just planned one side of a trade, don't try to trade the other side as well. You're just going to get yourself into a mess, and it's going to be stressful. 4. A good zone is where the price moves sharp and fast. Usually before a move there will be an accumulation and a stop hunt. A demand supply zone can be one candle or a series of candles consolidating. Now this is often seen in the market. What will happen is they'll push down quickly, and let's put this into a 15-minute chart. What will happen here is the market will push up or push down quickly, like here, look. All of a sudden we have a big push down, and then the market starts to go up. Okay, so then everybody's thinking, well, are we going up, are we going down, and so on. So what you have to do is be careful for these moves. All of a sudden the market goes up and then down. Same here yesterday. If you notice, remember on the indices I was talking about NASDAQ. This is Dow Jones, but it doesn't matter, it's the same thing. If you want, we can open NASDAQ as well. You see how the market makes a sudden move down. Why? Because they just cleaned out all the stop losses. They wanted to touch a level. Coincidentally, more often than not, it'll touch RPST level, and RPST pricing was here right at the low actually yesterday. So the market moved quickly down, and then in the trading hours moved up. Now this happens a lot, and a lot of people will get stopped out because everybody's stop loss is somewhere and the market is hunting for them. So if I do this on a 1-hour chart or a 4-hour chart, let's see. Yeah, there you go. So people's stop losses were pretty much there, okay, under this here. So they stopped everybody out. Let's see if there's anything in the background here, and filled in a gap. You see how they filled in the gap here? So they fill in a gap, all good, ready to go up. Okay, so sudden moves you should be aware of. They'll fill in gaps, they'll take out stops, and then carry on the opposite way. Okay, so this is why we're always trying to buy the lows, sell the highs. With timing and pricing together, you have a very good chance of constantly being on a higher level of success with these.